Are you willing to invest in real estates with low investment? Do you want to start the real estate business with no experience and being at a very young age? Here with the help of REITs, it's going to be possible in few bucks without any kind of tedious works. REIT stands for Real Estate Investment Trust that allows individuals to invest in large-scale income-producing real estate. A REIT is a company which owns and typically operates an income-producing real estate as well as related assets. Investing in REITs is a great way to diversify your portfolio outside of traditional stocks as well as bonds and could be attractive for their stronger dividends as well as long-term capital appreciation. Here are 5 types of REITs which you need to consider in the year 2023. Number 1. Retail REITs. Approximately 24% of REITs investment are in shopping malls as well as freestanding retail. This represents the single biggest investment by type in America. Whatever shopping center you frequent, it's likely owned by a REIT. When considering an investment in retail real estate, one first need to examine the retail industry itself. Is it financially healthy at present, and what is the outlook for the future? It's important to remember that retail REITs make money from the rent they charge tenants. If retailers are experiencing cash flow problems due to the poor sales, it's possible they could delay or even default on those monthly payments, eventually being forced to the bankruptcy. If these parameters are satisfied, you could choose that particular REIT in your portfolio. Number 2. Residential REITs. These are the REITs that own and operate multifamily rental apartment buildings as well as manufactured housing. When looking to invest in this type of REIT, one should consider several factors before jumping in. Considering an example, the best apartment markets tend to be where home affordability is low relative to the rest of the country. In the places such as New York as well as Los Angeles, the highest cost of single home forces more people to rent, which drives up the people landlords can charge each month. As a result, the biggest residential REITs tend to focus on larger urban areas. Within the specific market, investors must look for a population as well as job growth. Generally, where there is a net flow of people into a city, it's because jobs are readily available as well as the economy is growing. The falling vacancy rate coupled with the rising rents is a sign that demand is improvising. Number 3. Healthcare REITs. Healthcare REITs will be an interesting subsector to watch as Americans' age and healthcare costs continue to climb. Healthcare REITs invest in the real estate of hospitals, medical centers, nursing facilities, as well as retirement homes. The success of this real estate is directly tied to the healthcare system. The majority of operators of these facilities rely on occupancy fees, Medicare reimbursements, as well as private pay. As long as funding of healthcare is a question mark, so are the healthcare REITs. Things you should look for in healthcare REITs is a diversified group of customers as well as investment in number of different types of property. Number 4. Office REITs. Office REITs invest in office buildings. They receive rental income from tenants who have usually signed long-term leases. 4 questions come to mind for anyone interested in investing in an office REIT. What is the state of the economy and how high is the unemployment rate? What are the vacancy rates like? How is the area in which REIT investors doing economically? How much capital does it have for acquisitions? Try to find REITs that invest in economic strongholds. It's better to own a bunch of average buildings in Washington DC than it is to own prime office space in Detroit, for example. Number 5. Mortgage REITs. Approximately 10% of REITs investment are mortgages as opposed to the real estate itself. The best known but not necessarily the greatest investment are Fannie Mae as well as Freddie Mac. They are government-sponsored enterprises that buy mortgages on secondary market. Just because this type of REIT invests in mortgages instead of equity doesn't mean that it comes without a risk. An increase in interest rate would translate into a decrease in mortgage book values, driving the stock prices lower. Along with that, the mortgage REITs get a considerable amount of their capital through secured as well as unsecured debt offerings. Should interest rate rise, future financing will be more expensive, reducing the value of portfolio of loans. In a low interest rate environment with the prospect of rising rates, most mortgage REITs trade at a discount to net asset value per share. The trick is finding the right one. The key to assessing any REIT. Keep in mind the following points when assessing any REIT. REITs are true total return investments. They provide high dividend yields along with the moderate long-term capital appreciation. Look for companies that have done a very good job historically at providing both. Unlike traditional real estate, many REITs are traded on stock exchanges. You get the diversification real estate provides without being locked in long-term. Strong management makes a difference. Look for companies that have been around for a while or at least possess a management team with loads of experience. Quality counts. Only invest in REITs with the greater properties as well as tenants. Consider buying a mutual fund or ETF that invests in REITs and leave the research and buying to the pros. As per the Security and Exchange Commission, a REIT must invest at least 75% of its asset in real estate and cash and obtain at least 75% of gross income from the sources such as rent and mortgage interest. As with all investments, REITs have their advantages and disadvantages. One of the biggest benefits REITs have to offer is their higher yield dividends. REITs are required to pay out 95% of taxable income to shareholders. Thus, REIT dividends are often much higher than the average stock on S&P 500.5. Another benefit is portfolio diversification. Not too many people have the ability to go out and purchase a piece of commercial estate for the purpose of passive income generation. However, REITs offer the general public the capability to do this exactly. Furthermore, buying and selling real estate often takes a while, tying up cash flow in the process. Yet, REITs are highly liquid. Most can be bought and sold within the click of button. However, there are some drawbacks to REITs of which investors should be aware, most notably the potential tax liability REITs can create. Most REIT dividends don't meet the IRS definition of qualified dividends. That means that the above average dividends offered by REITs are taxed at a higher rate than most dividends. Another potential issue with REITs is their sensitivity to interest rates. Generally, when Federal Reserve raises interest rates in attempt to tighten up spending, REIT prices fall. How to invest in REITs? If you decide to open a brokerage account and the process is straightforward, you will provide a basic contact details as well as certain personal details. You will be asked for some additional information about your income, occupation as well as investing experience. Depending on which broker you choose, you will be able to sign up online at their website or mobile app or in person at a branch location. Once your account is open, you can access to online, use the education as well as research tools available to begin reviewing possible REIT investments. Your brokerage account should also have a screening tool that can assist you in fine-tuning your research and selection. Once you have chosen the REIT investment that best fits your financial needs as well as investment goals, you can proceed to buy it online. Before you do, make sure that you understand the nature of fees that your broker may charge and the fees or expenses associated with the actual investment. In what REITs you should invest in the year 2023? Each type of REIT has its own risk as well as upsides depending on the state of the economy. REIT investing through a REIT ETF is a great way for shareholders to engage with the sector without needing to personally contend with its complexities. REITs. As with any kind of investment, there is always a risk of loss. Publicly traded REITs have the particular risk of losing value as the interest rate rise, which typically sends investment capital into bonds. Are REITs safe during a recession? Investing in certain types of REITs, such as those that invest in hotel properties, is not a great choice during economic downturn. However, investing in other types of real estate such as healthcare facilities or retail is the greatest way to hedge against a recession. They can have longer lease structures as well as it could give a better level of returns at the time of future. Now, comments below. Are you going to build a portfolio for REITs in the year 2023? If you are already a real estate investor, comment your opinions about REITs. Will investment in REITs help you in becoming landlords at future? Comment below. Thank you for watching. See you next time.